Hello, winning investor nation. Ian and Amber here with your weekly Monday Market Insights webinar. Thank you for tuning in. And please remember to give us a thumbs up if you do and like the content of these videos, as it does support the YouTube channel. And also please subscribe and click that bell for all the notifications when a video posts. So good morning, Ian. How are you? Hope you had a great weekend. Hope your day's off to
Thanks.
a good start.
Yeah, I'm excited to get this week going. We got a lot of news to cover this
Oh,
week, and I see Alex is really amped as well behind you.
yeah, as amped as Alex will ever be. You
Yeah,
should have saw him earlier this morning. He was really amped around 5 a.m. So
he
now he's
looks like a chair cushion right now.
Alan, you're like the new chair cushion, Alex. That's funny. Okay, Ian. So on the economic front, we'll begin with that. We're actually hunkering down this week and waiting to see what happens at this week's annual Economic Policy Symposium in
Mhm.
Jackson Hole, Wyoming. So, Ian, you know, the meeting, which will be held from August 25th through the 27th, well, actually will feature a highly anticipated speech by Fed Chair Powell on August
Mhm.
26th. And we'll actually be paying close attention to what he has to say on future Fed rate tightening policies going forward. So in the Fed's July meeting minutes, it revealed a dichotomy stance on inflation. They're seeing risks on both sides. First of all, central bank officials actually see a risk that they're not actually tightening monetary policy enough to bring down inflation. As well, they may be hiking more than needed and leading the economy toward a recession. Chairman Powell did state in those July minutes that future interest rate increases will be data
Mhm.
dependent. And in all, inflation remains the Fed's primary concern through the minutes from July's meeting. And they were actually the most dovish since December of 2020. And I was checking Bloomberg data, and they're showing about a 50 basis point move in September. Could be 75 basis point, could be 50. But the Fed will likely get back to 25 basis point hikes per meeting so it can quote unquote calibrate when to end tightening. So by mid 2023, rates should begin to moderate, staying holding in a steady position. But what does that mean for us, winning investor nation? Well, where our next gen stocks are concerned, we're actually in them for the longer term because their innovations solve problems. Yes, they offer technological solutions today that will lead us to a future forward world. So markets will be volatile for the coming weeks for the time being, due to broad economic data as it comes in. But know that share prices and Ian's and our select recommendations across the portfolios, they're low. And if you believe as we do, their future growth is going to be, this is great. So it's a good time to actually buy slow,
Mhm.
buy low. So how do you feel?
Yeah. I love the way you frame that, Amber. And I would just add that I was reading some Seth Klarman over the weekend, and
Okay.
he's a famed money manager who's had just incredible returns over the past 3 decades.
Right.
And he talks about how, the big money is not really made in bull markets. It's made in bear markets like we have now, because, the bear market is the time to position yourself, to kind of take inventory of what you have in your portfolio and get ready for the next bull market. I mean, bull markets are easy, but bear market is like, you want to look fit, you want to look good.
Mm-hmm.
The bear market is the time that you're going to spend in the gym getting to that final, reward or outcome.
Mm-hmm.
And that's basically what a bear market is. And the problem with, a lot of investors, especially retail investors, have is that they enter the market in the bull market when everything looks great, everything looks rosy. I mean, the truth is, it's the bear market when you have to position yourself and get ready for the next bull market. The bull market is really just, the show off, the final outcome, but all the work is done now in the bear market. And obviously, we have been just kind of going over the portfolio and figuring out what we're going to keep, what we're going to chop to get ready, position ourselves for the next run that we have, which I think, is going to start slowly at first. This market right now is 3 steps forward, 2 steps back.
Mm-hmm.
We had 3 steps forward in July and mid-August, and now we're seeing 2 steps back. And I think it's just going to continue like that. A lot of volatility going forward until the next big uptrend starts, which which could happen really later this year when it seems like the Fed is going to be on hold and has moderated inflation enough.
Right. That's a good point, Ian. Very good point. Now is the time to really hunker down and get ready for that
Mhm.
bull market. That reward is forthcoming, everyone, especially in our particular stocks. So, looking at the economic calendar, Ian, for this week, we're expecting a number of releases. So Tuesday,
Mhm.
August 23rd at 9:45 a.m. and 10 a.m., August preliminary S&P Global U.S. Manufacturing PMI Purchasing Managers Index, which actually tracks the sentiment among purchasing managers at manufacturing, construction, as well as service firms. And
Mhm.
July's new home sales will post respectively. Both show potential for softening. Ian, just before we got on, you're mentioning PMI. What are your sentiments on PMI, what we're going to see for this?
Well, for both numbers, bad news is good news. And we're
Mhm.
just in this market environment where you want to see the economy slowing down faster than the street estimates.
Right.
Because if the economy is slowing down faster than everybody predicts, then the Fed is going to be, not need to tighten as much to head off inflation. And that's actually better for the market. And, when we see these numbers that come in a little hotter than expected and the news is good, you see the market sell off. So what I'm looking for in the home sales number one is that the number of new home sales is less than expected.
Mhm.
And we're looking already with estimates about a 40% drop in the number of new sales year over year. So you are seeing a significant slowdown in housing. Remember last year, everybody was just buying houses left and right. And now you're actually seeing inventory sit on the market. You're seeing price cuts. The
Mhm.
mortgage rate, which last year you could have gotten a 30-year mortgage rate for around 3 to 3.5%. Now it's like 5.5%. So it's increasingly difficult for people to buy houses.
Yes.
But that's a good thing because we're seeing a slowdown in the economy. With the PMI, what's important to look for is that the services number last month was below 50,
Mhm.
which indicates a contraction, a true recession in the economy. Right now, estimates are for 50, so it could go either way.
Mhm.
I think the market's going to like it if it's below 50, not too far below 50. You don't want to see 40 or anything like that. That would be a pretty significant slowdown. But you also don't want to see something, at 55, which means that the service sector is steadily growing because the Fed's going to be wary of inflation again. So what I'm looking for is the fact that bad news is still good news in the economic data this week.
Okay, well said. And I have to say, on a personal note, I'm always looking at Zillow and in my own
Mhm.
neighborhood, and there's a
Right.
feature on Zillow that lets you look at price reductions. And I can tell
Mhm.
you about 50% of the homes that were on the market at whatever price they came on the market at, 50% of them have now done price reductions because they're not moving, they're just sitting. So,
Yeah. And one other stat too, while you bring this up that I was reading recently is that 25% of new home sales over the last year
mhm.
were second houses, investment properties. And I think a lot of investors are actually buying properties because they're able to monetize them using Airbnb
Right.
and you can
Mhm.
easily rent them out. So it becomes more of an asset that you can get a steady stream of cash flows for. And for a while, when houses were really cheap, they were a lot lower than what people could get for them on Airbnb. But I think the rise in house prices has kind of lowered what they call cap rates, which is basically how much return you can get by buying the house from your monthly rental, or if you do an annual rental or week by week on Airbnb. And I
Right.
think those have kind of balanced out in the last couple of years. But that's sent a lot of demand for housing basically. And at the same time, we haven't been able to build houses as quickly as we want to do because it's
Mhm.
hard to hire people in the construction sector. The price of materials and lumber was through the roof earlier this year. And then, of course, a year and a half ago, you had a major slowdown in new home building because
Mhm.
of COVID.
Mhm.
Um, and so, we're looking to see more inventory, more housing building, prices coming down, and this housing cycle, which I believe peaked earlier this year, takes about a year and a half before prices finally, and that's been on average. It takes about a year and a half for the prices to finally some type of equilibrium. So I do continue to see prices for new homes falling
Mhm.
over the next year or so because that's just typical for the housing cycle.
Okay, good point, Ian. Thanks for sharing that. So continuing with their economic calendar, actually on Wednesday, the 24th, a July preliminary durable goods orders will post at 8:30 a.m. A softening is expected there as well with this print. And on Thursday, second quarter's second reading of GDP annualized quarter over quarter. And July's personal income and personal spending will post at 8:30 a.m. The second quarter second reading, Ian, for GDP and personal income are expected to remain unchanged from their previous prints. But of course, personal spending is forecast to show a slowdown, a slight decline there.
Yeah, maybe we'll see whether or not we're really in a recession finally.
Yeah, we'll see. We'll get some telling numbers. So stay tuned, everyone, for sure. So, Ian, I have a crypto question for you because I have it, and you're our crypto experts. I wanted to ask you. Cryptos are selling as some Fed officials actually reiterated their resolve to keep ratcheting up, raising interest rates until inflation is tamed. So, Ian, how do you see this playing out for Bitcoin in particular over the longer term?
I think that's a great question. The idea that Bitcoin was this non-correlated asset, which means that it doesn't go up or down with stocks and bonds, also brought out the idea that it would be somewhat inflation resistant. Whereas, if you have high inflation, it means normally you have high amounts of fiat currency being printed, and Bitcoin being an alternative to high amounts of fiat currency being printed will maintain its value. Now that's held for areas of the world like Argentina and Venezuela, where they had crazy high rates of inflation, which meant that the valuation of their fiat currency has gone down. But in the US, there are a lot more headwinds, let's say. We don't have runaway monetary printing like they do in a lot of emerging markets. And then, I also tend to believe that like the idea of like gold as being an inflation hedge in the short and medium term, that doesn't necessarily work out. And you see instances, at least I've seen over my career, when you have higher inflation or inflation expected to rise, you actually see commodities like gold and silver haven't done well. And so, I think that the narrative of Bitcoin as being digital gold will play out over the longer term, but it's hard to predict it in the shorter term. So that's why I say you should have a portion of your investment account in cryptocurrencies, right? Has to be a small manageable position. Don't put 50% of your investments into Bitcoin thinking that if inflation goes up, it's going to go up as well, because that doesn't necessarily happen. But beyond Bitcoin, there are other currencies that have just much larger prospects. And the question I always ask is, would you rather own all the gold in the world, or would you rather own the internet? And if you want to own all the gold in the world, you can own all the digital gold in the world by buying Bitcoin. On the flip side, if you want to own a cryptocurrency that will provision scarce digital resources and create a new modern decentralized internet, then there are other cryptocurrencies like by Next Gen Coin and other layer ones available that you can invest in. So, I am a big believer in the crypto space. I don't think Bitcoin in 10 years is going to be the most valuable crypto asset. I believe there are others that will eventually surpass Bitcoin because they have much larger markets that they're addressing than Bitcoin.
Okay. Actually, I'm glad you mentioned that your next gen coin there, Ian, because Ian has a really great product out for his crypto service. And if you're really interested in learning what his next gen coins of choice are, which are really good to know, please click the bull icon image right here over my shoulder to get all those details on Ian's next gen coin promo and information. So thank you for that, Ian, and answering that question for me. So I'd like to switch gears a little bit and talk about megatrends and innovation. And there's something that's very interesting that I was reading about online and on articles. Well, 3D printing technology actually just got a very big legislative boost in. Last week, 3D printing construction or additive construction reached a major milestone. As reported by 3D Print, Montana has become the first U.S. state to, quote, give broad regulatory approval for 3D printed concrete walls. Tim Stark, a general contractor, applied for and received permission from Montana's Department of Labor and Industry to use concrete walls as an equal replacement for standard concrete masonry units or just basic concrete blocks,
Mhm.
end quote. So Stark will be using a method created by Apis Core, a 3D printing construction firm based here in Florida. Apis Core is one of three 3D printing construction firms that I featured in my August 9th Winning Investor Daily article titled 3D Printing Trio Set to Disrupt Home Construction.
Hmm.
So you can check out the article at winninginvestordaily.com. If you're not part of that e-letter yet, it's a free e-letter. Please sign up if you like to Winning Investor Nation. This additive construction regulatory approval is a major step in the 3D printed home market. And as a leading 3D printing construction consulting firm actually points out, quote, nothing in construction happens without standards. Standards enable mass adoption and acceptance, which encourages further developments in materials and approaches and enables competitive pricing, end quote. So Winning Investor Nation, if you're invested in the 3D printing mega trend, these are the type of developments that we like to and need to see for 3D printing tech to be adopted and accepted by the masses. And in my next Megatrend Thursday webinar, I actually will be taking which actually will come out Thursday, August 25th of this week. I'm taking a deeper dive into the latest breakthroughs in 3D printing market and how best to invest in this growing industry. So please stay tuned for that. But isn't that interesting, Ian? It's all about legislation that makes a difference in an industry, right?
Yeah, definitely. It's like government sort of, there's technologies out there and just waiting for government to open the floodgates. And
Mm-hmm.
and that was really comprehensive. And I would just add that 3D printing also in terms of like home construction and additive materials,
Mm-hmm.
it's important for the millennial boom as well, because like as we mentioned earlier, the problem in the United States is that we don't have enough housing, right? We
Mm-hmm.
need to be able to build more. We need to make the cost of building a house cheaper. We need to be able to do more with less.
Right.
And 3D printing, concrete walls
Mm.
basically helps us fulfill that. I've seen those videos where the little robot goes around and builds a wall. I just think it's so fascinating,
Amazing.
and
Mm-hmm.
just imagine a future where the cost of building a house is significantly lower than it is right now.
Mm-hmm.
We've seen in other sectors that technology has disrupted where the cost of doing business has dropped dramatically. And I'm thinking about genomics, right? Where the cost of sequencing a human genome has gone down 99.9% over the last couple of decades.
Wow.
Another industry, electric vehicles, the cost of a kilowatt hour in a lithium ion battery to
Mm-hmm.
produce has gone down 94% or something like that. The cost of flying into space has gone down 90% in the last couple of decades. So now we're getting to the point of the technology cycle where it's not just about software and artificial intelligence lowering the cost of doing things. You're actually seeing manufacturing costs drop because of new types of innovation. And when this application is, get dedicated towards the home market, it's going to be massively disruptive for our economy. And I believe in this concept, and we've spoken about this before, that
Mm-hmm.
Buckminster Fuller came up with. It's called ephemeralization, and
Mm-hmm.
it's the idea that you're going to wind up with abundance in society and not scarcity. Economics was always based on this idea that we have scarce assets, but technology allowing us to do with more with less is creating an abundance. And all our portfolios and everything we invest in is really focused on this idea of abundance. And 3D printing, especially when it comes to construction materials,
Mm-hmm.
is really something that's going to be driving the future as well.
I wholeheartedly agree with you, Ian. And speaking, you're mentioning EVs. I want to just leave with one little fun note, Ian. Something that
Mm-hmm.
actually came true in a conversation we had a couple of weeks ago, right here on this webinar, is regarding the following. We can actually start to say hello, Ian, to the Dodge Charger Daytona SRT Concept E muscle car. So this is a
Mm-hmm.
new electric vehicle that will be powered by a new 800-volt Banshee propulsion system designed to be more powerful than an ICE Hellcat engine, which is pretty cool. But here's the thing, it won't be a quiet car, Ian. It's actually going to make sound. which is something
Oh, exciting for you.
exciting to see, right? Because that's what we're talking about. I'm like, I love EVs, but I still have this fascination with exhaust sound. Well,
Yeah,
here's an EV that may solve that problem for people like me. So I thought that was,
exciting.
isn't that exciting?
Yeah,
And
one thing with EVs too, I was riding my bike around town this
okay.
weekend,
Hmm.
and I don't like that there's quiet cars approaching. When you're on a
Hmm.
bike on the street, I like to hear the car coming. So,
Okay.
you can hear the road tires and everything. You just can't hear the engine. So a lot of the Teslas in the town I'm staying in right now really creep up on you.
Oh no. Well, we can't have that. Well, Dodge to the rescue. And
Yeah.
others will probably follow suit. So
Well,
you'll
I think Elon has to make some type of, if their car is approaching you on your bike, maybe it sends out some type of sound. I know the original Fisker Karma
yeah.
at low speeds made this weird like electronic sound. So if you're driving around a parking lot, let's say, and there are pedestrians walking around, like they're notified that there's a vehicle in your
Oh,
vicinity.
oh, that's
Mhm.
pretty cool. Well,
Yeah.
well, hopefully that will be reintroduced in for future EVs coming forward. So that would be cool.
Hmm.
Okay, speaking of EVs, everyone, Ian's actual next stock recommendation being revealed in September's Strategic Fortunes newsletter, his newsletter, is actually focused on the growth of this megatrend, all about electric vehicles. So to make sure you get the stock ticker for his
Hmm.
recommendation as soon as it's released, well, please sign up for Strategic Fortunes newsletter by clicking the bull icon right here over my shoulder to get those details as well. So, Ian, I think that does it, at least for me regarding this week's webinar. Do you have anything more you'd like to share?
Well, I think we covered pretty much everything. I'm glad that you highlighted our pick that's coming out at the end of this month because, as we said, this is a company that is in a huge mega trend. It's not only electric vehicles, it's also connected devices. And, the best part is this is a profitable company. There are so many companies out there in technology that aren't making money now, and they're having a hard time in this market with the Fed raising rates and everyone worried about, future cash flows. So this is a company that is going to be much better positioned to withstand the bear market that we're going through right now than a lot of the other high flyers. Now, there's room for your portfolio for high flyers as well. I'm not casting negative doubt on those. I'm just saying that if you're going to add new stocks to your portfolio, this is one that actually makes money, and it comes at a great valuation given the market's pullback over the last 8 months.
I agree. So, if you'd like to learn more, click that bull icon and get started with Ian's upcoming stock pick, which is just about a couple of days away. Ian, not too far away.
Yep. And also, if you have any other comments or questions or anything you'd like to see Amber and I address, please feel free to leave them in the comments below. And again, I'll just remind you, please smash the like button. It helps us get our content out to other viewers so we can share our message with the world.
Oh, yes. I love it. Music to my ears as always, Ian. So everyone, thank you so much for tuning in, staying with us and watching. We appreciate you so much. And know that you can follow Ian and me on Twitter. Ian is at Invest with Ian and I am at A Lancaster Guru. So for me, I like to just say take care and have a great week ahead. And Ian, it's all yours.
That's all for me. Have a great week. Thanks again for tuning in, and I'll speak to you soon.
Talk soon, guys. Have a great week ahead.